Here, we'll be looking at the financial analysis of Wilson Bank through years 2019 through 2023. We see in 2019, actually, Wilson incurred some debt as their debt ratio was at its highest in the 5-year span here on the chart. However, it is important to note that the same year they had returned on assets, better known as return on investment, around 1.34%. This is really good in the banking industry. It lets you know that the business is profitable, and that's very important on a case study like we're doing here. Even though they were a profitable company, the debt they incurred was very high, but you can still see they returned a profit even with incurring that debt. Through the following 4 years, you can see that they're able to healthily pay off that debt while keeping a stable, positive ROA. This graph here on slide 10, it shows this graph here puts the data set from slide 9 in perspective. You can clearly see the return on equity and the return on asset stays steady and rises. And at the same time, you see that the debt incurred is steadily decreasing. It's also good to note here that your debt and your ROA and ROE are not volatile. So it's healthy growth. Moving down to slide number 11, you can see the key changes here. With the return on asset, there was a noticeable increase in return on asset during the onset of COVID-19, which could indicate that the bank managed to effectively utilize its assets to maintain or even increase profitability during the pandemic. However, there was a slight decrease from 2021 to 2022, suggesting some changes in asset utilization or earnings. For the return on equity here, we have the bank showed a strong growth trend and return on equity, particularly between 2020 and 2022. This signifies that not only recovery post-COVID, but also an improved ability to generate earnings from equity, possibly due to operational efficiencies or marketing positioning. The debt ratio here that we talked about earlier in the other two slides, we could see that it went down. Like it says here, there was a decrease in the debt ratio from 2021 to 2022, suggesting a stronger balance sheet with a lower proportion of debt to assets. This is generally a positive sign of financial health, like I was saying in the last two slides as well. For the market share, for the data provided, there is a notable decline in market share from 2020 to 2022 with a slight recovery in 2023. This is obviously because the pandemic occurred. This has pretty much affected the whole entire stock market. Lastly here, we have slide 12, which is just a comparison with the industry. So it compares to other businesses in the industry and gives you a good look on the health of this business. First up is the return on equity here. Wilson Bank sets at around 12.39%. The industry average is 13%. So this is right there at what the average is. And with some of the banks like Chase and JP Morgan being around that 13-15%, you can see that Wilson definitely isn't lower in the pack. Even though they are slightly below 13%. The insight here is slightly below industry expectations. Like I was saying, there's potential for more improvement for profitability, just like any company. Return on assets here, Wilson Bank's at 1.39%, and the industry average is at 1.3%. You can see that Wilson actually uses their assets a little bit better. They get more money out of them than the national average here. Wilson Bank Holding Company slightly underperforming in return on equity, like it's shown above, but shows a small advantage on return on assets. Lastly here, we just have slide 13, which is the recommendations. We would need